Our companies are looking at, oh, if he's not paying, if he's not using it anymore, then we can close that account. Okay, so it's just important, even when you pay your bill, your credit card down, maybe go get some coffee or pay for gas, pay it back. Swipe it again, pay it back. Okay, the other part that's not often told to you is that your due date on your credit report might be the 7th of the month, right? The due date that they want you to make your payment by. Oftentimes, the credit issuing company, so Capital One, or you got a Bank of America credit card, they will report your balance usually a few days before the due date. So sometimes I tell people, call your credit card company, find out when are they reporting to the credit bureau, not just the due date. If you pay it on the due date, you're paying on time, but remember, they're reporting this information to get a score on your credit report. And if you were planning to pay that down on the due date, well, you still got a balance on a week before when they actually reported it. I know it can be confusing, but call your credit card company. Oftentimes, if they say you have a due date of the 7th, usually about 5 days before that is going to be the actual date that they're reporting to the credit bureaus. There's a strategy behind that. I don't have time to go into all of that right now.
I have another question.
Yes, sir.
So just to follow up, sometimes you have people who have a lot of credit cards and decide I'm going to pay them off and cancel them. How does that impact your credit?
So if they've had those cards for years, that's a disservice to them. Because again, so one of the items on your credit scoring model on that table I showed is new credit, 10%. So this is a number, 10% of your credit score is on new credit. So those are inquiries, so new things you're applying for. 15% is how long you've had credit. So let's say 20 years ago, you opened your first credit card and you paid that okay, you paid it on time for the most part. If you close those cards, you just lost 20 years of on-time payment history. And 15%, it's not as much as the 35 or 30, but 15% of that number comes from how long you've had those credit cards open. So when you apply for new credit cards, some lenders will take the average. So if I open a card today, that's 0 days that I've had that card. I got another card that's 20 years old. They're gonna take the average of those days, which might be like 8 years, 9 years when they look at it. So it's gonna affect a little bit the length of time that I've had the credit. So it's always better, you know, you can't avoid paying off a car loan or a mortgage. You know, you're not gonna reactivate that unless you refinance it. So those are different, but a credit card, it's revolving. It's best to keep those open as long as you can with low balances and paying them on time. That's the strategy. Mary, question for you. So with mortgage applications, on the credit side, what are you seeing the biggest challenge with borrowers that might apply with you? Anything you might want to share? I'll put her on the spot.
Yeah, I think, gosh, yeah, that you did put me on the spot. A lot of people are scared to have credit cards because they don't, they don't want to use them irresponsibly, and that's fine, but you have to have it to have a credit score. So, I talk to a lot of people and they're like, I'm old school, I don't like credit cards, but you have to have something so that you have that credit history building. And he mentioned, how long have we had these cards? Or, if you are someone who you're just establishing credit, I usually tell people, we need to wait at least 3 months. Preferably 6. So if you guys are thinking about purchasing, let's look at your credit now to take the steps, put the steps in place so that 6 months from now you're ready, or even 3 months. It really just depends. But you have to have that history. And the credit bureaus, Victor touched on this. Some creditors will report to the credit bureau just one day a month. It might be the last day of the month, but you made your payment, on the 10th. So we pull your credit on the 15th and they haven't reported yet that you made that payment. So, you know, if we're looking at that credit history, that's why I usually tell people, let's look at it in 3 months, because by then we should have hopefully at least 2 months reported on the credit bureau. So it's definitely a timing thing. And I always tell people too, you know, I've been doing this since 2005, so 18 years I've been a loan officer. So I've seen everything. And I'm also a homeowner and knew nothing about buying a home when I bought my home. So everyone starts in the same place, or we don't, you know, nobody really has a ton of knowledge, especially when you're a first-time home buyer. So that's really, I think, the most important thing is let's look at it early and figure out what we need to do to get you on the path so that 3-6 months down the road, you're ready.
There's a question here.
Yes.
So how many number of accounts, credit cards are considered healthy?
That's a great question. And I have a slide about that on here in just a moment. I'll show it to you. They want a mixture. I will give you in general a mixture of credit. So having a little bit of installment loans, maybe a car loan, a mortgage. They want to see revolving credit lines. I'm going to show you an example here. So I'm going to finish your answer here in just a moment because I have a full slide that explains that. Just real quickly. So a few years back, maybe 2016 or 15, somewhere in there, judgments came off of pretty much everybody's credit. So if you ever got sued and a judgment ended up getting reported against you, they were putting that on your credit report. Well, a few years back, they stopped putting that on there because if my dad's name is Victor Johnson and my name is Victor Johnson, they would not have the judgment with my social. It would just have my name and an address. And if I ever lived with my dad, then they could confuse his judgment on my credit report. And they were seeing that that was a problem, and so they cleared that away. But on your credit report, if it's a bankruptcy or a judgment and it actually has been filed with the county, that will be on the credit report. So I just want you to be aware of that. And again, I'm coming to your answer. Inquiries. I get this one a lot. Yes, sir. You have a question?
Before you get into the inquiries, actually, that's where I was coming to.
Okay.
How is it true that the number of times you check your credit score, the lower it gets?
That is not true. If you are pulling your credit, so you can pull it as often as you can. I suggest that everybody go to annualcreditreport.com. You can pull it once a week for free. They won't charge you nothing. But if we pull it, or another creditor pulls it, and another creditor pulls it, that's a hard inquiry that we're talking about. But you can pull it as often as you like, and it will not bring your score down. It's when someone else is pulling to determine your credit score that it will affect your score.
So what's the rationale? Is it when I pull it, is it the same report that you guys find?
Especially if you go to myfico.com, those are the same reports. The difference is you're not going to issue yourself credit. You're right. You're not pulling your credit to see if you can give you money. But you know what I mean? But you coming to us, it's saying that you want to borrow money. And when other lenders are looking at the credit report and they see you went and asked Prosperity Bank, Frost Bank, Bank of America, Wells Fargo for money, it says that you're a risk. But if you pull it, you're just trying to keep up with your credit score. If you have one of us pull it, it's because you want something. And that could mean that you don't have good money, you're trying to borrow from everybody, and that's a risk that they don't want to take on.
That's clear. My last one, so that I don't take other. We talk about a debt ratio.
Yes.
I know you've mentioned that it's better to have different accounts, revolving accounts. How do you measure your debt ratio? Income.
You want to take this one, Mary? I can, kind of. I got you. All right. She can help me later if needed. So we have a front end and a back end debt to income ratio, right? In general, we're looking at the consistent bills that are being reported to your credit report. So if you got, if you pay rent, a car loan, a student loan, and a credit card, those will be considered debt that you have. And they're gonna divide that into how much money you earn. Gross, right? In general. Usually, so on the front end, we're looking at the gross dollar, not net, the gross dollars you make, divided by how much monthly payments are reporting on your credit report. Usually, that's going to be, 30 to 35, 40% of your income is going to regular bills that you pay, right? We want you to be usually under 40%, 45% on some of the products. But typically, that's going to be how they measure it is, what are the items reporting on your credit report divided by how much money you actually earn every month. And if it's close to 45%, you're in the danger zone. You want to keep that around 40, maybe less than that is obviously even better. Yeah, question, then we got you in the back.
I think you mentioned about the FICO score and
Yes.
the Vantage score.
Yes.
So my bank tells me I'm excellent. So will that translate to excellent in the FICO score or they don't do?
Not necessarily. So the Vantage scores, and I don't have a chart for this, but so you saw my pie chart. Vantage scores have a slightly different variation on the chart. So where they might give you more positive credit for paying on time versus FICO, they're saying 35% is about the right number. Vantage might say 42%. I think it's about that actually. So if you're paying bills on time on Vantage, it looks better because they're giving you more credit for on-time payments. On FICO, remember 90% of lenders are looking at FICO. They want their credibility to be solid. They want people to, banks like us to go to them and say, wow, when I pulled Gideon's credit report and it said that he's about 700, that means that he usually pays his bills on time. Let's loan him the money. If I pull your Vantage and they say that, it says, well, that same 700, you really is 750. So I'm thinking you pay all the time on time and you might pay once late. It's just a different credibility, and FICO has proven over 30-something years that their data is pretty predictable about how the person is going to behave with a new loan. That's what all of this is about. Your credit score is really a predictor of, based on what you've done to this point, how are you going to perform with a new loan? That's what the bank is using that to determine. Like, based on how they pay this bill, that's probably how they're going to pay our bill. Okay, so I don't know if it's just been waiting on me. All right, good deal. So there was another question in the back. Yes.
Yeah, I really like the way you answered his questions because in our community we have people who've probably just come into this country. What would you best advise them to get started their credit? Because some of us are like, we don't want debt, but
Yeah,
what would
yeah.
what would be your best avenue for them to
Yes.
get
So I
started
should have
with some
started with
credit?
this.
Yeah.
This is educational information only. All right. I'm just giving you suggestions and guidance based on my expertise. Okay. I would suggest maybe getting a couple secured credit cards, right? A secured credit card is like a savings account. You put maybe $200 into this card. They're going to charge you maybe $25 as a processing fee, an annual fee. The rest of it is your credit limit. And again, you only use 20% of that. Pay it on time, use it, pay it, use it, pay it. That's going to build your score up. Maybe a couple of those cards, that should help you quite a bit with building. To Mary's point, you will have 0 items when I pull your credit report until at least 6 months of some kind of open credit line. Okay, so if you just moved here, get those secured cards maybe real quickly, or a gas card, and use it once a month, pay on it on time, use it some more, and that should start building you good credit. And actually, it will give you pretty great credit because there's nothing else on there except for these on-time payments. So that would be a suggestion for building good credit up. Great questions, guys.
Question.
Very good point. So Mary suggests Experian is one of the 3 credit bureaus. So you see up here, you got Equifax, Experian, and TransUnion. Those are 3 of the 3 major credit reporting companies. They're calculating this stuff. So Mary's great point. Experian allows for what's called an Experian Boost. You can add your cell phone bill, your utility bills to your credit report. Now, from what I remember, they're going to want access to the account that you pay from, because you got to set up on automatic payments. So if you don't want them in your business, open up a separate little account that you pay your bill. You put money in there to pay your power bill, your water bill, your cell phone, and those payments get reported to the credit bureau. That's a great, great way to build your score up, in addition to probably having a couple secured credit cards. And it's free of charge. They don't charge you for that. Okay?
Okay, question.
Yes.
The preacher asked a question like when you check or when your credit is checked, your scores drops. How long does it take for that to be resuscitated or to look healthy again?
They come with the big dog questions today, buddy. Woo, woo. There's no straight answer because, as Mary mentioned, data is getting reported throughout the month. So today it might show like this, the next day it shows like this. Typically, it's going to be at least 30 to 45 days because, again, it takes the full cycle for them to update the information. But if you, oh man, you guys are asking good questions. We're coming to some meaty stuff here in a second. So if you kept your scores in the 700s all the time and you make one late payment, you might lose 100 points because they expect more from you because you're in category A, which is the 700 plus scores. If you're in the 600 to 699s, you might lose 50 points. They expect much of you, but not as much as the 700. You know what I mean? It's a little bit different, right? A little bit different caliber. And then if you are always in the 600s and you pay late, you might not see but 5 points get lost because they expect late payments from somebody in that category. I didn't make this stuff up.
Just one more question on
Yeah.
that. There's soft inquiry and hard inquiry. What's the difference and how does it impact your credit score?
Okay, let me see if it'll let me move back. So the soft inquiry, next one. Soft inquiry is him pulling his credit report himself, okay? Or, let me just read from here. So you have soft inquiry, it's gonna show me on my next one. So hard inquiries are the big stuff. Again, we're pulling mortgage credit, credit checks, automotive. If the lender is pulling your credit, those are typically hard inquiries. If you pull it, it's typically soft, or if you already have a line of credit with the bank or the lender, and they just do a check annually just to see where you're at, that would be a soft inquiry as well. You won't have as much, if any, hit at all. But the hard ones are, I'm applying to get money, check out my stuff, right? Oh, okay, we got you. You still might only lose 3 or 4 points, but it's still an inquiry. It's gonna be a hard inquiry versus you pulling yourself. Or if you are active in a credit line already, they call it a refresh. Sometimes they'll refresh just to see if you're in the same place or in a better position. You might sometimes, if you've been paying bills on time and you've already got a Capital One card, they offer you, hey, we want to upgrade you from 1,000 to 2,000. Because they were just doing a soft inquiry and they see now your deposits have gotten larger this last year for some reason, right? Oh yeah, let's throw them some more credit. That's just how it goes. Or the opposite, income went down. Oh, we're gonna take that 1,000 and knock it down about 500, okay? But these are, again, they're trying to measure how you manage borrowed dollars, okay? Really good questions here. All right, I'm not gonna touch on this very long, but I will say, if you were applying for a auto loan, they allow you to do what's called it's the grace period where you can do inquiry. Oh my God, I just had a brain fart. But basically, where you're doing rate shopping. So you go to one auto dealer, another auto dealer, you're trying to see who's gonna offer you the best rate. They will allow you, once you pull that first credit report with GMC, they can allow you up to 45 days. I just tell people 14 because Experian only gives you 14 days. And you can go and have your credit pulled for an auto loan, the same type of loan, and they won't affect you each time, just that one time. I will tell you though, if you're going to buy a car, I would take my credit report into the dealer and do not sign the form that says I authorize you to check my score with any other lenders. Because what'll happen is they'll just keep checking and keep checking, and it'll be 100 inquiries on your credit report because they've shopped it with all these different lending companies. So it's very dangerous to do that. If I'm buying an auto, or maybe, I don't know if we do it on the mortgage so much, but definitely for auto loans, those companies will send that out and see who's the best, who's gonna offer the best rate so that I can put this guy or lady in a car today, okay? So you do have a grace period, I say about 14 days on that. Okay, I gotta talk about this one. Please do.
So I want to go back real quick to how to build credit. So secured credit card, yes. If you do not have a credit card, I would recommend, and I do recommend to my clients, try applying for something like a gas card or like a TJ Maxx, like a store card. Their requirements are usually a little bit lower. But if you get declined, you will get a letter from them stating why you were declined, and it'll give you instructions on how to obtain your credit report for free. Follow those instructions. I wouldn't go and apply at 10 different places. Try it once. If you don't get approved, then look into the secured credit card and get the free credit report. The other thing that you can do, if you have a family member that already has a credit card and it is in good standing and it is not maxed out, so if the balance is less than 30%, you can ask your relative to add you as an authorized user on that card. You don't need a copy, you don't need a card yourself, you don't need to charge on it. But basically, if they are able to add you as an authorized user, and they just need to, call Discover and say, I would like to add an authorized user, you inherit their credit history. And, like I have an older sister and she has two nephews, and they are two kids, my two nephews. So they did that with my nephews so that when they were at a point where they needed to go buy a car, they had a credit score because they had already inherited their parents' good credit. There are some caveats on that. Obviously, you want to do it with someone who is responsible and hasn't, pays their credit cards on time, has that low balance, and then also have them call the company first and ask if they report to authorized user, report to the credit bureau on authorized user accounts, because not all do. So even if you add someone as an authorized user, let's say it's Home Depot, they may not report to the credit bureau for that authorized user. So you want to make sure you're adding them to a card that the company actually reports to the credit bureau. Otherwise, it's not doing you any good. Inquiries, I will say, Prosperity, we pull your credit once. I've seen where people will go, and I know when they've shopped for an auto loan, because literally these auto financing companies, they'll run it 12 times. Prosperity, only we pull it once, and that's it. The soft pulls, and this is me taking my loan officer hat off as just a consumer. I'm very skeptical of people who tell me it's a soft pull. Like if I go anywhere, like a car rental place, and they say, oh, it's a soft pull, I'm like, no. So I don't let people pull my credit even if they say it's a soft pull. The other thing I wanted to touch on is that 14-day grace period. I agree with the 14 days because the point of you having multiple mortgage companies or banks pull your credit is to find the best rate. If you're pulling it on the first of the month and then you wait 30 days, the rate is different anyway. Interest rates change daily and sometimes more than once a day. So if you are trying to shop a rate with multiple lenders, doing it over a 30-day period, it's not going to help you. So definitely I would keep it within that 14-day period because otherwise you're not even really comparing apples to apples. And it can hurt your credit to drag it out that long. I'm trying to think what else. Does anyone have any questions to what I've said?
You understand?
Does that help?
User thing. That's good. Yeah, I forgot.
Yeah.
Bringing that up. That's
Yeah.
a great way.
Yeah. There's some, if you Google, there's some back and forth about this. That's why, like I said, make sure you're being added to a card that they do actually report authorized users to the credit bureaus. And then obviously making sure you're being added to someone's card that's responsible. Yeah. There was something else, but I'll let you.
Keep rolling. All right. So no, that is good on the authorized user. I got a buddy of mine in California that added his fiance. Well, excuse me. His fiance already had good credit. She added him to help him build his score up. But I gave her the title of fiance for a reason, because they were planning to get married. And you know how women start planning the wedding and she starts swiping cards and planning the party, and that card went up, maxed out. And she didn't help him the way that he thought she was going to help. His score went down instead of going up. And so he was like, oh, hold on, I got to get, how do I get my score back up? Get off the card first, and then you got to work to build it back up. But you inherit that person's activity. So you want to go, that's why usually it's a grandparent helping a grandkid, because they've already gone through their little living my best life swiping card activity. So, all right. So let's see where we at. Disputes. Woosah. When we go to these credit repair companies, I know somebody who pays $119 every month for a credit repair company to help them build their credit. They've been with this company 3 years. Their credit has not gotten better. 119 times 36, y'all do the math, it's over $5,000, just about, okay? Gone. It's gone, okay? The scores never went up. That was the whole point of that. This is what the credit repair company has been doing. Putting dispute marks all over this person's credit report. Oh, they didn't really charge this, they didn't really charge this. Well, what happens is the credit reporting agency, Equifax, Experian, TransUnion, they have to put a pause on reporting that because you've said that this is in dispute. So that item is no longer calculated into your credit score. And what happens? 2 weeks later, you pull your credit, your score went up because that negative item is in dispute. And the credit repair company, see, I told you, I was going to help you get your credit up. And the credit bureau is going to send letters to you, send letters to the creditor to say, hey, this person said they did not charge this account. Is this a valid debt? And they go through a process of validating the debt. And they figure out that, yes, you did actually open that account and make those charges and stop paying, and why it's on your credit report as a negative item. 45 days later, the investigation has ended. The dispute item gets removed from your credit report, but the debt stayed because it was validated as a legitimate debt. Your score just dropped back to where it was at before you started that dispute process. So what happens is these credit repair companies, they smack a bunch of dispute items on these items on your credit report. And then when you come to us, it's like, oh yeah, your credit score is 680, but you got 7 disputed items. So we got to get that figured out and cleared up. And then once that clears up, if those legitimate items stay, now you went from a 680 down to a 580 and you can't get a loan. Okay, so it's important not to just dispute items unless you legitimately know you did not open that card. Somebody else took your ID and opened up credit. Disputes are not helping your score unless you legitimately have proof that you can validate that you did not open that card up, okay? So be careful with disputing items. Anything you want to say on that? Yeah, let's do it.
Also, any disputed debt on your credit report basically creates higher risk from a loan underwriting standpoint. There's mortgage guidelines for all loan programs. For example, FHA, which is very, very common, been around forever, very safe, stable loan that a lot of first-time home buyers will use. Any disputed, it automatically requires more stringent underwriting. So I've been there where you have something pop up and you're like, that's not mine, or I already paid that. It's better to just pay it and move on, because putting a dispute, like Victor said, hurts in many ways, and we see that a lot. So definitely, I just don't recommend disputing. Just chalk it up to, I'm going to pay this. But if you pay something, keep really good records. Keep a receipt. Keep the correspondence from the company. And when I say keep it for years, because we have seen that sometimes these collection companies are a little shady, because you'll pay that. They make money off of selling it to another collection company to have you pay it again. So it can crop up years down the road, even though you've already paid it. So keep records, keep them for a long time. That's just keep an accordion folder, however you keep records. But paper trail, if you get an email, create a folder on your desktop, drag that email over so you have good records. And then the other thing I want to say is these credit repair companies, yes, they charge you monthly. They do not do anything. If you run into trouble with anything, with credit, and you reach out to a credit company and they say, okay, we can help you, but stop making your payments. Don't make these payments, because they need to show on your credit report that they're not being paid, and then we'll be able to negotiate a settlement for you. So let's say you've got a $4,000 balance and the rate is 29% on a credit card or whatever. And they say, well, stop making the payment. Once it's 90 days late, then they're willing to negotiate with you. Please don't do that, because that takes, your credit scores are going to go down in the 500s. So late payments on credit, being 30 days late, it's going to hurt your credit. If you let that roll to a 60-day late and then roll to a 90-day late because this company's told you to stop making your payment, it takes years to come out of that. Takes years. And the other thing is, from a mortgage underwriting standpoint, that is considered a Chapter 13 bankruptcy. Not a Chapter 7, but a Chapter 13, where you're negotiating a lower payment and then you're going to make payments. So from a mortgage underwriting standpoint, it's really looked at as a bankruptcy. So, even if all you can do is make the minimum payment, try to make the minimum payment.
Really good information. I hope y'all taking notes, because that was valuable information there. Like, credit is just such an important piece to everything we do in the States as far as borrowing money. And so if you're not in a position where you can pay things off, just set up a payment plan with the creditor instead of trying to work with these credit consolidators and credit repair companies. Most of the time, it doesn't work out. Look, the bottom line is, you got to pay it on time, regardless of if you got somebody else managing it or you doing it. It's just going to come down to you being able to manage those debts on time and getting them paid off. Okay, so back to the question back here in the back about the mixture of credit that you should have. So I'm going to give you an example here. So they say here, having multiple types of good standing credit accounts is part of the scoring process. They want to see that you can manage different types of credit. An installment loan, like an auto loan, revolving credit, like credit cards, and things like that. So client number 1 has 1 open auto loan and 2 credit cards, but there's nothing else on his file. All 3 accounts are in good standing. He's never late. So this guy's got an auto loan and 2 credit cards. That's it. He's paying on time. Pretty good shape. Client number 2 has an open auto loan, 5 student loans, 2 credit cards, and a mortgage. All of those accounts are in good standing. He's never late. Client number 2 can show on-time payments across multiple types of loans and credit, right? The scoring models are better able to predict this person's repayment and can give her credit for her good standing activity. The credit reports are all about them figuring out what you did with these people. Can you do it again with the new loan? So there's more information for them to study about you. If you got an auto loan, 5 student loans, 2 credit cards, they call that having a hefty file. Your credit file has a lot of data that we can look at. The first person, even with 3 accounts, that's a thin file, and it makes it harder for creditors or lenders to be able to say, they're on top of it. We know that we're going to be in good standing. So it's kind of weird. We're telling you, you know, if it's coming to loans, you got to be able to show that you've managed debt great. Though you might be old school, you like to spend cash, that's not proven to me that you could borrow money and pay it effectively. So that's what this is all about. Any questions about that? And that's why even adding the Experian Boost might help, because you got a few other cards there or accounts that you can show that you've been paying on time. Yes, sir.
How about debt consolidation? Does that help?
I'm not a
Does it
fan,
hurt?
right? Debt consolidation typically is what Mary described, where they're going to have you make sure all these accounts get charged off first, because they can negotiate when it's charged off. They can negotiate it down to 25, 30, 40% of what you owed once you're charged off. But if you get the charge off, that's like a bankruptcy, a foreclosure. It's just the worst thing that could happen to you, because you said, I'm just going to let it I'm not going to pay it at all until we hit the wall. And the creditor wants it to be charged off, because then they can just write it off with the IRS and say, oh, that was just a loss. They're in good shape. Sell it to a collection agency for a couple dollars. They made a little money there. And the collection agency is going to keep selling it and selling it and selling it, selling it, selling it. But you, on the other hand, your score just steady dropping. You're looking bad. You can't get no money from anywhere because you've just got too much going on. Debt consolidators are depending on their ability to negotiate a settlement because you're already at a loss. You can negotiate that before you get to that point with most creditors, right? This old guy told me, bad news does not age well. So when something's going bad, just confront it. Just get right at it. You know what I mean? Don't let it simmer, because that's just going to make the situation worse, right? So I'm not a fan of debt consolidators. Okay. All right, we're coming towards the end on the credit stuff. We talked a little bit about age of account. Having older accounts on your file can show more of a history and how he or she interacts with accounts over time. Just like I got some grades coming out my chin, people expect me to be more mature and handle myself better than when I was 20 years old. It's similar to how credit works. When you're new, they already know you're going to be wilding out, swiping the card everywhere you can. You might not pay on time. But as you get older in time with your credit accounts, you learn how to manage them, pay them on time, keep the balances low. That's the same thing it comes to with age of credit. They want to see more maturity, more activity over years, as opposed to somebody who just started borrowing credit, okay? And what else we got on here? So we talked about scorecards. I think there's a chart that shows this. Okay, so we talked about how they put people in these categories. They call it segmented scorecards. So again, if you've consistently kept your scores at 700 or higher throughout many years, you are in this top population. So they expect you to always pay on time. So the second that you swipe late or excuse me, pay late, you're going to fall into a lower bucket, which means that, you know, it's going to affect your score greatly. As you fall into the lower buckets, it won't hurt you as bad, but you're already in the middle tier anyway. That's kind of what they're looking at. So it's just know that they categorize people based on where you're at with your credit scores. So few years back, you know, my scores, I was in the low 500s back in 2013, 14. I worked 2 years to get my scores into the 700s. Me and my wife, I started eating peanut butter and jelly sandwiches, stopped eating out, stopped charging everything, started paying my bills on time. I set up a lot of automated payments for cards and for my auto bills. And my score eventually moved up 200 points over a course of about a year and a half, 2 years. About a year later, we had already bought a house, and something was going on while I was between companies. The company went out of business. I didn't get a severance check, so I was late with a car payment. And because I was in the 700s now, that one late payment dropped me back to like 620. I lost like 100 points for being late one time. And I had been late on a car payment before, back in my 500 days, and it didn't hit that hard. Back in the 500 days, it hit different. Now I'm in the 700s. They're like, oh my goodness, what are you doing? Swipe. Bad drop. So once you get there, you know, and all this is kind of talking about the same thing, the different types of credit scores that you have. So I want to answer any other credit questions. And then I want to go to another quick slide. I want to talk a little bit about commercial lending. I'm not a commercial lender, but I've received some information from our commercial lenders that will be beneficial to you guys today. And then we'll talk a little bit more about mortgage applications. The biggest thing I want you to take away from this slide here, credit is a very important part of your mortgage application. Don't disqualify yourself. Right? Don't say, oh, my score is this, I'm not even going to apply. That's not the strategy. With anything that you do, you're going to have to just start. Just get out there and start the process. And you can adjust and modify as you learn more. You know, I forget how the saying goes, but take the next step and then the next step will be revealed. You just got to keep moving forward. And with Mary here, if you've been thinking about applying for a mortgage or buying a house, she's a great resource. Let's just see what's happening. Let her tell you what you need to do. And again, with our partners, we can give you great, accurate information that says, look, all you need to do is pay $250 on this credit card and maybe pay off this collection, and you're in the game. But if you try to figure it out on your own, you might, say, oh man, I'm too far out, I'm not even gonna try. Or let me pay off all these collections first, and that might not be the best thing to do. So let Mary work with you first, look at the totality of your application, and then let her guide you. And if we need to go another step, I'm sure she'll be able to help you with that. So any other credit questions? Yes, ma'am, in the back. Yes, sir. Oh. How do I want to answer this? Right.
Well, sorry.
It's okay.
All right. Is it okay to use one credit card to pay off another one, even if you're not paying that like to zero? Maybe you're just leaving a little balance to keep it open, but you want to decrease the credit you have out there and then just focus on one credit card. How does that affect you?
So the credit reporting agencies are looking at the total of your debt. So really all you're doing is moving it from that chair to the other chair. I will say that it benefits you if the first card that you want to pay off has a 30% interest rate, and then you use one that has a 10% interest rate to pay that down. But you really haven't paid the debt down, you just moved it to a cheaper card, right? So that's the only scenario I could think of. Anything else you could add to that? I mean, you're really just moving the bucket, you know what I mean? So it's not helping you as much as you think yeah.
Yeah, if you are doing like a balance transfer to get a lower rate.
Right.
You know, let's say you get an offer from Discover that says you'll get 18 months 0 interest on a balance transfer, and you got another one at, 25, 29, then yes, I would say that.
Yes.
Let me see this.
And I'm gonna switch to the other slide. Switch to the other slide.
All right. So I'm looking at it from this perspective. Let's say I already have a car loan that I'm having to pay anywho, but then I still want to continue to build up my credit, but then I don't want to continue getting in more debts. So then I can schedule for this car automatic debit from my credit card. That way I'm paying that car and building on that end while paying on the credit card as well with the same money I could have used to pay towards the car note.
Yeah, you can definitely do that. Yes. Yes. And I actually, I do this for myself. You guys, we all have busy lives, and I am 100% a proponent of setting up auto debit payments on everything, because I don't know about y'all, but I will forget. So I definitely set up auto debit. And for people who do not like to use credit, and I'm that way too. If you have something, let's say like Hulu or Netflix, that we all have these subscriptions, you have a credit card, you don't really want to use it. You can set up for your Hulu to charge to that card, and then set up auto debit from your bank account, or like you said, another credit card, but then you got to set up another auto debit to pay that every month. So like for me, I have my Netflix go to this one card that I don't even use. I think it's in a drawer somewhere. I don't carry it with me or anything. So I have my Netflix charged to that automatically every month. And then I have auto debit from my checking account, pay that off in full every month. And yes, I do pay it off to 0, but I know it's going to charge again next month, so that it's continuing to charge and pay and charge and pay. And I don't even have to look at it. That's one tool I've been using for years, and I think that helped build my credit. The other thing I do want to say really, really quick, I know we've spent a lot of time on credit, but it is so important. So protect it. Co-signing. I know we love our relatives and whatnot, and some of them need help, but co-signing, especially on an auto loan, that is probably the number one thing I see that affects people, and it ends up being a charge-off or a profit and loss write-off or repossession. And and sometimes these are thousands and thousands of dollars that people just don't, you can't just throw that money onto it. But I talk to people all the time, and they're like, well, I didn't know until it was too late that my nephew wasn't paying the car note. I just, if you can avoid co-signing on something huge like that, I would definitely try to avoid it. If you can't, just know that even though they're paying it, it's going to go into your debt to income ratio. And the gentleman there in the maroon shirt asked about debt to income ratio. If you're co-signing for somebody, that payment is going to be included in the debt to income ratio. There are some caveats where we can maybe exclude that. If the person has been making the payment for 12 months out of their bank account. So they can't give you the cash and then you make the payment, because we can't see that that person's making the payment. So we have to see that that person is making the payment for 12 months out of their bank account, and they're going to have to provide 12 months of bank statements showing that they make that they make that payment out of their bank account. But it's pretty rare that people even know that, and so most of the time there's no records. So if you go to apply for a house, just know that that payment's going to go against you also. So there's lots of reasons not to do it if you can help it. But that's probably the number one charge off we see. And it's, we look at that for 5 years. If it happened 4.5 years ago, it's an automatic decline for you until 5 years have gone by, and then even then it gets real tricky. So I think that was about all. We can talk on debt to income ratio again in a minute when we talk about the actual mortgage stuff, but did you?
I think I was asking a question regarding the debt income ratio.
Okay.
Does the medical bills count into?
No.
Okay.
No. If it is a medical collection, it will not. It won't count in your debt to income ratio. But that is a really good question, though, because other collections will count against you. So let's say you have a $300 collection from DirecTV, from an old apartment 3 years ago, that you turned in the equipment and they're still saying you didn't pay the bill, but now there's this collection. We do have to calculate a payment for that. The mortgage guidelines require, if you have collections over a certain amount, $2,000. So if you have 5 different small little collections and they are over $2,000, the total of them, we have to count a payment of 5% of the balance. So other collections can potentially hurt you. That's why I was saying, even though it's principal, I mean, I've had it happen to me where something's gone to collection and I'm like, oh, how did I never got that bill or whatever. Just pay it. Just pay it. If you can pay it, because otherwise it's going to hurt your credit and we're going to have to count a payment against you anyway, more than likely. So, but again, I 100% agree. You just got to jump in. So if you don't really know where your credit stands at this point, we just need to pull it. We just need to pull your credit report, look it over real good. If it's great, awesome. If there's things that we can do, to kind of tell you, okay, don't touch this one, but pay this one down. And it may just be paying it down a couple $100s to get it down below that 30% threshold. So, yeah. So,
A question on the debt income ratio. So I read somewhere that the student loan is calculated different when it comes to calculating the debt to income ratio. Is that correct? And then a follow-up is, if you have a debt to income ratio of say 30% versus 5%, how does that affect the terms of your mortgage?
it's a good question. Those are both really good questions. Student loans are tricky because while you're in, most student loans are going to be in deferment while you're still in school, or it's been a while since I've been in college, so I don't know how long it lasts after you graduate, that they stay in deferment. But so in that period where they're in deferment and you're not making a payment, they'll still show up on your credit report, but it'll have a zero payment. FHA, we have to count a payment of 0.5% of the balance. So basically, if you've got $60,000 in student loans, we're going to count a payment of 0.5% of that to your monthly debt to income ratio. Conventional loans, and this is sort of a generalization, but 1%. So if you've got a $60,000 student loan, it's a $600 payment a month. That's a car payment. That's a big chunk. So do keep that in mind, because I talk to people all the time and they say, oh, well, yeah, I've got student loans, but they're all in deferment. And I'm like, yeah, but you went to medical school. So, we still have to count a payment on those. So that definitely does impact a lot of people who are brand new out of college and have those student loans, or even not even people who are brand new out of college, but like some teachers, their student loans are in deferment because they have a term where if they work a number of years, five or 10 years, then they'll be totally forgiven. So during that time, they're all in forbearance, but we still have to count a payment. So that is definitely a great question. Does that answer your question?
It does. And then on the your score on the debt to income ratio,
Yes.
I'm assuming lower is better.
It is. It is, as far as debt to income ratio doesn't play into interest rate. Term, though, let's say you've got a 5% debt to income ratio. I would talk to you about, do you want to do a 15-year note, which is going to be a better rate than a 30-year fixed? So most people, especially first-time home buyers, are going to get into a 30-year term. That's just what most people do. But if your debt to income ratio is lower and you are comfortable with a little bit higher payment to shorten your term, you're going to get a little bit lower rate. Now, that some people are like, no, I still want the 30-year fixed because I want the lowest payment option available. So we would just kind of have to talk about, your scenario. How long do you plan on keeping this house? Do you think you'll, upsize and have a family and, you need a 5-bedroom instead of a 3-bedroom in 3 years or whatever? So there's lots of different things that go into that. Lower debt to income ratio, though, isn't a given that you're going to get a lower rate. Does that help? And then I'll just touch on this real quick with debt to income ratio. So Victor mentioned a front end. That is your housing expense. So basically, we're going to, for people who are not self-employed, okay, you work for a company, you're a W-2, you get your hourly pay stub, that we use gross income. So I would say, how many hours, a week do you work? 40 hours. What's your hourly pay? $10 an hour. That is how we calculate your income. For self-employed people, it's different. And in those scenarios, I highly recommend send me your tax returns because that actually goes off of net. So, we'll talk to people and they say, I'm self-employed. I make $300,000 a year. But their expenses for that business show them making $40,000 a year. A good CPA is going to write off as much as possible. Is there anyone self-employed in here right now? Okay. So self-employed? You are? Okay. So if you have a CPA, it's their job to find ways that you are paying the least amount possible, So you've got to show less income, so you're paying less income taxes. That hurts you when it comes to a mortgage, though, because that net on self-employment is what we use. It's opposite for W-2 wage earners. We use gross. So self-employed is tricky. I mean, I have people, I'll talk to them and they're like, I'm self-employed, I own 2 businesses. And I'm like, go ahead and send me your tax returns. I'll do the calculations for you because, and especially this time of year, it's actually a good time of year to, if you are self-employed, to reach out to a loan officer because it's right around this time that you're going to start thinking about, okay, how am I going to file my taxes for 2023, right? So before you go to your CPA and say, here's all my, my 1099s and expenses and stuff, let's crunch the numbers now so that you can let your CPA know, look, I need to show more income so that I can buy a house this summer. So this is what, I consulted a mortgage originator, kind of crunched the numbers. I need to show this amount of income. So definitely, again, the sooner you start on that, the better it is. And it's a good time of year to do that because most people are starting to think about taxes for next year already. But the front end ratio is the housing expense that we usually want around less than 33%, maybe 33 to 35% of your gross income. The back end is the house expense, the projected house expense. So if we're saying your house expense is, on this new house is going to be $2,000 with taxes, insurance, and the loan, we add that to whatever shows up on your credit report. So a car note, your student loans, your credit card minimum payments, that we want 40 to 45% usually. There are a couple loan programs we can go higher, but again, you need to figure out in your budget what payment you want to keep your house payment around. Because a lot of lenders will tell you, oh yeah, you're qualified for this amount. Y'all aren't going to like that payment. So, that's the thing. The important thing is to look at your budget, see what you're currently paying out, and see what is the payment I really want my house payment to be around, because we don't want you getting in trouble. And once you determine that, we can back into it and say, okay, if you want your payment to be $1,500 a year, the maximum house price you're going to be able to buy is this amount. And then you kind of talk to a realtor and say, I need to look at houses in this range. And keep in mind, some realtors are going to try to push you higher too. So anyway.
All of that here in a second. So the big thing that Mary talked about was so many different nuggets in there. You got to just connect with a mortgage loan officer when you're ready to buy a house, because they're going to tell you what's the best product, what that can fit within the rates that you're looking for, the payments that you're looking for, all of those type, and based on your scenario with the taxes and income. So I'm going to take a couple of minutes real quickly to talk through the 5 C's of credit from our commercial lender. Let me see here. Okay, you got me.
Can I ask a quick question though? Just
Yes.
one last question. From the lender's perspective, is there a different requirement when you're looking for a mortgage versus a construction loan, if you just wanted to get a loan and construct your own house?
No, not really. Yeah, not really, and not in general. All right, so I'm gonna show you real quickly. I got it. Next one. Go ahead.
With a construction loan, it might have a larger down payment.
Go ahead.
So if you are looking to purchase a house that's existing, you're going to have more options for a lower down payment. Like FHA is 3.5% down payment. Conventional would be 3% down payment. Our construction loans, the down payment is 15% is the lowest down payment. So construction loans are a little bit riskier, so they do require down payment. Now, if you already own the land, then that down payment might go away, because you might have already have equity in that land that goes to the down payment. So, but as far as credit requirements, pretty much the same. Yeah.
And those are the items I'm actually about to run through really quickly here. Feel free, if you're close enough, take a screenshot of it. These came straight from my commercial lender, the 5 C's of credit. This is whether you're looking for financing for construction loan or just for a business in general. A couple of things here. So 5, capital is number 1. Do you got some money? All right, she just mentioned the 15% down. Do you have some cash to put in the deal? Because no more are you seeing there, 0 down, buy this house with no money down. It's just, it's risky. All right, so do you have some money to put down into the deal? Collateral. So again, if you're starting a business, let's say you're starting a restaurant of some sort, do you already have equipment that can be leveraged as collateral? So I got a stove here, I got a couple tables here and all that. Together, that adds up to about $20,000 worth of potential collateral. In case your business doesn't generate the revenue that you projected initially, they want to know what collateral do you have that if you had to, you could sell it and apply it towards the debt that you're applying for. Conditions. Again, basically what Mary said, the terms, the rate, the covenants. But another thing in conditions that a lot of people don't think about is the condition of the industry that you're in. If I wanted to start a thriving hotel or Airbnb business in March of 2020, when we started a pandemic, it's kind of a risky business to go into at that time, right? So the lender's also going to say, whoa, wait a minute. You projected you're going to have 30 nights a week, 30 nights a month booked out in this place, and it's a pandemic. Ain't nobody going nowhere. Ain't nobody want to stay anywhere. So the conditions of your industry could play a part into whether or not you get that loan or not. Character, that's pretty much what we've been talking about this last hour, is your credit. Do I have good track record of handling debt? But also character could be, what are you putting out there in the world, social media wise? Like, I mean, you may not think that, but it's just a chance somebody could look at that. And if you're out here bashing Prosperity Bank on social media, we might see that. I don't know, we won't mess with you, you know. And in capacity, do I have the income to support this additional debt? So that's where it comes to your business plan. Like, do you really understand the ins and outs of your business? Can you properly project over the next year, 3 years, 5 years, what kind of revenue within a certain range are you going to generate? So these are the 5 C's that they're looking for as it relates to if you wanted to build, you know, on the land that you already have. As Mary mentioned, if you already own this land, then that land can be leveraged as collateral. Like I'm talking about collateral here, you already have ownership and some equity in the land. And depending on what it evaluates at, that land could be enough to where you don't have to put money down for the development of more construction on that land. Again, I'm not a commercial lender, so if that's something you want to do, I'm going to get you in touch, Gideon, with one of our key commercial lenders so y'all can talk specifics. But another thing to think about is we have what's called a one-time closed construction loan. It's tough to get them in. You got to turn in a lot of paperwork. But what the concept is that if you don't own land, that you could acquire the land and the cost of development and do your permanent financing once that development is complete, all in one closing. And where that helps, if you know, if we get everything we need up front, you don't have to have a second closing and additional closing costs and things like that. So if that's something you're interested in talking to, I'll get one of my commercial lenders to talk to you next week. Yeah. Oh, good. I didn't know that. Okay, very good. Very good. We'll go to the next slide, the next PowerPoint. All right, so anything else on just this space you want to talk? All right, so we're going to spend this last probably 20, 30 minutes and just really dig into mortgage applications, right? To be able to get approved for a house. You know, we've talked to a lot of details around that, but while I got Mary's expertise here, I'm going to go in a little deeper and talk about the home buying process. And then we'll get you guys out of here. We'll probably leave a few minutes just to answer any additional questions that may come up. Yes, sir.
Quick question before you transition. What type of loans do you offer to people who are interested in the real estate business? Specifically, you have a single home, but then you would like to own another unit, multiple units. What does Prosperity have for such a setup?
Full transparency, we're not the best source for that type of loan because I'm a real estate investor with single family houses as well. I've talked to these guys ad nauseum at the office about it. Because of the way we do business, they're going to make that a commercial loan. So regardless of what happens, you're looking at probably 20% down, right? And I think right now we only have a 15 or 20 year mortgage on that. So as an investor, I want the payments as low as possible. So I need that 30, right? So I need the cash flow. And right now, we've suspended the products that would be most useful for that. There may be some changes in 2024, but still talk to me because I may have some other resources for that. Unless you want to add anything on that. You know, I believe in being fully transparent and honest. That's probably not the best product for you to come to us for. You want to buy a house, do some construction, yeah, we got you. Yep. But we just, yeah. Yeah, go on, dig in.
There are lending guidelines around things like that. I just closed a fourplex for a client recently, just like 2 months ago. He owned a home already. He purchased the fourplex on an FHA loan, and it was a $520,000 fourplex in Tarrant County. 3.5% down on this FHA loan, but he has to live in one of the units. Well, let me just say this. Nobody's going to come back and see if you're still there. But you have to state that you are going to live in one of the units as your primary residence. So, he had to write a letter stating, I plan to move into unit number 1 with my fiance or something like that. But so it kind of depends.
That was his personal credit. That's not under his LLC.
No, that he purchased that under his personal credit with his personal income. FHA is only allowed for primary residences, so that's why he stated, I will be living in this unit. We don't want to break rules, but there are some circumstances, obviously, where it would work if you are looking to purchase some different things. Yeah. And the other thing about Prosperity that I really, really, really like is Prosperity allows, if you want to purchase a home and you have a relative that's going to live in it, we will do that as a second home. Most lenders will require that to be done as an investment property, which an investment property loan is always going to be a higher rate, always. I'm working with a client right now. She is purchasing the house next door to her, and has stated her son is going to live in it. We're able to do that with Prosperity as a second home. So that's kind of nice. We have some more lenient second home rules than a lot of other banks. So that's nice.
What I got from that, you got to be creative, man, when it comes to your investing, just think of a strategy. So because of time, I was going to show this video. I don't have to go into this, but there have been systemic things that have happened that prevented black people from being able to buy houses. I show this a lot of times when I'm at black churches, just so that we understand the landscape. But things are more transparent now. But I do want you to be aware that in the United States, 44%, these numbers are through the end of 2021, about 44% of black households own a home. Right? So 44 out of every 100 households actually own real estate. In the Hispanic families, 50%, just over 50%, 62% on the Asian, white Americans at 73%. Again, we won't go into the history of all that, but my job at Prosperity Bank is to help close that gap for black homeowners. So I'm really interested in finding ways to connect. That's why you even got this email, because I was trying to connect with people who are already doing business with Prosperity Bank and see if we can find ways to help them close this home ownership gap with mortgages. We've talked about why these challenges happen. The big thing is the scores. We really need you to be in that 640 FICO score, not the Vantage score, or higher. Obviously, the higher, the better. But we want to be able to get scores that are higher. These have been reasons why a lot of black families have not purchased homes. They're still paying 100% interest in rent to somebody else, a landlord. And then right now you get people that complain to me like, well, interest rate's almost 8% right now, but you're paying 100% if you're renting right now. So so just think about that. Also, the debt to income ratio that we've talked about quite a bit, and thank you for the clarity on that, Mary. And then not showing stable and consistently growing income, or at least stable income. These are 3 primary reasons why mortgages get declined. And so hopefully talking to you all today about these things, you start paying closer attention. But you're going to do a lot more talking on this one, Mary. So typically, and this is a slide that compliance approved us on, but these are the type of questions, and I think we've kind of talked to it already. If you can ready to buy a house as your individual family, how much am I comfortable spending on a monthly basis, right? Just think about it. So she just broke down, how much can I afford to pay a month? If I'm looking at about $2,000 a month, how much does that translate into from a mortgage perspective, right? So understand those numbers first. And to get to that number, I encourage people to do a budget, like a real budget. Look back at the last 3 months of your bank statements. Where did every single dollar that came in go? Cups of coffee, I don't care, bills. Look at that, and can you make adjustments? We said a minute ago, move forward, but then be ready to adjust as needed when needed. All right, do I have enough money to put down? So have I saved any money? Obviously, there are down payment assistance programs, but I'm gonna speak from my own personal perspective and my knowledge. I would go get gift funds before I take a down payment assistance program, because you're gonna pay a higher interest rate on the down payment assistance program. Yes, they're gonna probably give you money interest free, but there's fees associated with it. So I'd rather go to Uncle Bud and see if he'll loan me $10,000 to help me buy that house, as opposed to taking $10,000 or $5,000 from a down payment assistance program, where if you don't stay in that loan for at least 3 years, in some cases, maybe longer in some others, they're gonna charge you for that money. You gotta pay that back, right? So there's all these different things, and I'll let you speak on to that. And then the third piece is, how long do I see myself living in the home? So again, if you know that you can put a little bit more down, you don't mind paying a little bit higher mortgage, because in 15 years you want to have this house paid off, well, then you need to be thinking about that from the upfront. But really thinking about, am I just buying this house so that I can stop renting and I'm gonna just get the first house that I can afford? That's still smart in a lot of cases. At least now you're building equity, and maybe a couple years down the line, you could sell that house, or better yet, refinance it, get some money from it and rent it out and let somebody else pay that payment, and you go buy the house that you really want. So there's a lot of things on that. You want to speak to anything on this particular slide? We're gonna go into like the pre-qualification stuff here next. So, okay. So next, so we just talked about that. So what are the things that are going to be looked at qualifying for a mortgage, and why your credit is important? So I spent an hour talking about credit, because not only is it going to affect how much we ask you to put down and possibly that interest rate, but private mortgage insurance. So if you put down less than 20% on that loan, you might have, more than likely, private mortgage insurance, which is another payment added to your mortgage payment that protects the lender, right? Also, what type of loan you get is going to determine what that credit score, how that gets calculated in as well. And I think we talked pretty good about the credit piece. All right, so here's the big stuff though. The credit score, your income, your monthly pre-taxed income, so the debt to income ratio, your debt obligations, and how much cash you have accumulated for your down payment. So these are the things that Mary's going to ask for up front to see where you are, what we need to do to help you get across that finish line to the closing table. Just let me know when you want to jump in, if anything. All right. A mortgage pre-approval. So in the home buying process, and we'll kind of start with the basics. So if you wanted to go buy a house today, you would have to have a pre-approval letter from Mary at Prosperity Bank that says, we have checked this person's application and income and credit and predetermined that they are probably eligible for X amount of money. And let's say it's $250,000. And so she will be able to take that pre-approval letter and give that to you. And now you can take that letter to your real estate agent and start making offers on houses that are in that price range. You can't submit offers without the pre-approval letter unless you're doing a direct handshake transaction with the seller. But typically, there's a real estate agent for the seller, a real estate agent for the buyer, you. And so for that transaction to get submitted to a title company and start the process to get it scheduled for closing, you got to have a pre-approval letter that says that we have predetermined this person's eligibility for a mortgage, and we feel comfortable moving forward saying that we would be able to loan them X amount of dollars. And that's all stated on that letter. And that letter gets looked at by the seller's real estate agent. Says, oh, they already got pre-approval from Prosperity Bank. Okay, cool. This is a good offer. I think you should take this offer. They already been pre-approved. Okay. When the seller knows you are pre-approved, it gives them real negotiating power. So that if 3 offers come in and only one of them has a pre-approval letter. First of all, I don't know how they made an offer, but the one that has a pre-approval letter is the more solid one, because that says the bank is willing to back you, or the mortgage company is willing to back you. When you work with Prosperity Bank, we'll keep you informed and let you know. So we work in-house. Our team is in-house, underwriters, processors, all that stuff happens within our team. I put this slide in here because there are home buyer counseling programs out there. Typically, the housing authority for your county They offer education, kind of like what we're doing here today, where they'll talk to you about preparing for home ownership. And the ones that are really good will talk to you about how to manage your mortgage after you've closed. But those are programs that once you graduate, a lot of times they'll offer you the down payment assistance programs. And then we talked a little bit about self-employed applicants. Definitely tax returns are going to be most beneficial in that situation. You're going to pay a higher interest rate and you're probably going to put more down, but it's a way to get the deal done when you don't have a W-2, okay? The most important thing is the last bullet on here is be upfront about your finances with your mortgage loan officer. She's not here to hurt you. She's here to help you find a way to get those keys, okay? And let me just say this, since I'm dealing with a black audience, right? So again, I didn't show my video, but historically there have been times where when we put down that we are a black applicant, that has hurt us. It's hurt us on the appraisal. Sometimes it's hurt us with even getting approvals for the loan. There's so much transparency now that it's almost impossible for that to happen. But I will say that companies like Prosperity Bank and all of the banks and financial institutions have a federal requirement to do a certain amount of business with black and minority borrowers in the area that their bank is chartered in. And the way that they get measured is we got to be able to show on the application that general demographic information that says you check the box that says you're a black borrower. Again, sometimes through history, we've been afraid to check the box. We got to check the box, though, because I need to be able to show and prove to the executives at Prosperity Bank that, yes, we are doing the right thing. We're educating more black borrowers and more homes are being purchased by our community. If we don't check the box, we can't prove that there is improvement going on in that category. So again, and I can hold people like Mary and the bank accountable, because if we see that there's all of a sudden too many black applications being declined where the Asian ones are shooting through the roof or whatever, then at least I got the data that says, wow, what's going on here and why are we not approving more of these loans? The people are educated, they're saving their money, they're managing their debt. Why are these mortgages not getting approved? And so that's a little side piece that I add to it, is check the box if you've been asked about your demographic, because we need to show that the improvements are there. And we might not really be at 43%, 44% of home ownership. Think about it, if 20,000 black borrowers didn't check the box, but they got approved for a mortgage, maybe we're really at 50%, 55%, but we got to be able to show that data in order to make the improvement. And then the last things that I'll say, and I know Mary probably gonna chime in here, once you start the loan application, you in the mix, you in the process of we getting you towards that finish line to buy a house. Some things that you do want to do. She's already mentioned, keep good records of your documents. Keep good, accounting of all your documents. If you paid off collection accounts, you're making payments on things, whatever it is, keep those documents somewhere where you can find them. Obviously, it helps to just create a Google Drive where you don't have to go rummaging through somewhere, accordion file. I still have them, but if you got a folder, a Google Drive or something, you can find that stuff from your phone, from your laptop. Keep your accounts current. Continue to pay things on time. You're still in the process. And in some cases, sometimes they'll pull your credit again towards the end. I've seen that happen at other mortgage companies. Keep records of non-payroll deposits. So if you get alimony, you get other checks, you get other deposits, that's something that you want to make sure you can keep track of. Can you speak to a little bit about asset dissipation? Are you comfortable with that? I would love for you to just talk about that, because I had never heard of it until I got here, to be honest with you. So there's something known as asset dissipation. So I'm going to let Mary talk about that, and it'll help you with your approval.
I want to touch on what he just mentioned about pulling credit again at the end. So there are different types of loan programs. Some of them do require that a soft pull be done at the end of the loan, like within, I think it's 10 days of closing, within 5 to 10 days of closing. So there are some loan programs that we have to do a soft pull again. And if you've bought a car you're probably done. You know, I mean, it's a decline, and you literally were supposed to close in a week. So don't make any big purchases. Don't move money around. That's also another big one that we see a lot. Is people will think, oh, I'm gonna cash out my 401k. And it's just a nightmare. Like, the paperwork just racks up, because anytime you move money from one account to another, we have to have all the paperwork for it. So it's better if you have something that comes up. You know, I've had customers in the middle of a loan say, my car broke down, you know, what do I do? And, you know, definitely call your loan officer and talk about that. Asset dissipation is really nice. So if you've been with a company for a little while, you have a 401k, or you've got stocks or an IRA. Right. So let's say you have a big chunk of money that isn't income, but it's assets. We can use that amount of money to calculate sort of projected income. So that helps a lot of people, especially, it can help if you've got that money sitting there. It's not stuff you're taking from monthly as income, but we can basically turn that balance into a projected income. Not to say you have to then start drawing that money. That isn't what we're saying. You can leave that money sitting in that account where it is, but we're able to count an amount, and it's based off of a calculation that is not even worth talking about. But we come up with an amount. It gets added to your other monthly income as projected income. So it can help with the debt to income ratio. It helps. I mean, it's not all banks do that. Prosperity does that. I've been with Prosperity for 5.5 years, and the company I was with before for 12 some years did not do that. So that's really another great thing that Prosperity does that a lot of lenders will not do. So yeah.
Asset dissipation. Yep. So I know, Mr. Gideon, you probably got that $100,000 buried up under the house. Put that in the bank, and we're gonna calculate that out into your debt to income. You know what I mean? So if you got big chunks of cash some kind of way, or even if it's retirement money, that's just another way to help you add income to your loan application. We talked about the don'ts. Don't run out and go buy a bunch of appliances and stuff before you close and have them keys in your hands. Just wait. Just wait till you get it done officially. Then you can go charge over at IKEA or whatever and go get you some furniture for the house. Obviously, don't open up any new credit cards. If you change jobs, that happens. Things happen, right? Communicate with your loan officer as soon as you know about that, because we may need certain documents or letters or something to support that your income is not going to decline because of this situation. And as she mentioned, don't transfer money around and start closing out some of your retirement or savings accounts, because it just starts adding questions to why are you doing this when you're asking us for $300,000 to buy a house. We just need everything to just stay still while they're finishing up the underwriting process, okay? Just very important. That's a very critical time. And typically we can close in 30 to 45 days. I mean, that's kind of long, 45 days, but typically it's gonna be about a 30-day process. So you gotta just be very disciplined during that time to not have a lot of money movement happening. What else I got here? Just our team, again, our in-house operations. We pride ourselves on being very customer-centric and being specific to what our clients' needs. We got a lot of different loans, loan types, condo loans we do. We talked about the one-time construction and the bank statement loans. And that's that. Yes, you got something to add, please.
So going back to the assets, if you have that $100,000 under your mattress, it has to be in the bank. A lot of people, I mean, just a lot of people still keep money a lot of money at home. But that money it can't be used because we don't have any proof of it. So if you are someone who doesn't really like banks, if you want a mortgage, you got to put that money in the bank. You have to show it. And we have to see, what I recommend is do it ASAP, because we will ask for the last 60 days of bank statements. And if there is any large deposit over 50% of your qualifying income, number one, you're going to have to explain it and what they call source it. And that's where I said a minute ago, don't move stuff around, because it just creates a whole lot of questions. It's a whole lot of paperwork. So if you are going to deposit, say you make $5,000 a month in for your income, if you're going to deposit more than $2,500, well, I definitely recommend depositing less than $2,500. Don't go over that 50% threshold. But if you know you're trying to buy a house, get that money in the bank so that when we ask for those last 2 months bank statements, that deposit is already gone. It's not even visible on those 2 months bank statements. So closing, yes. I personally never like to say less than 30 days just because we have some compliance timeframes that we have to adhere to that we just can't get around. Also, there's things that sometimes are out of our control, like title work and appraisal. We do not do those in-house. So if you've got a property that you inherited from someone that's been in your family for, a little while, the title work might take longer. So sometimes the title work and appraisal take longer than we anticipate or longer than normal. So I just personally don't like to ever say less than 30 days, but we can do it. We try, but I just always like to set expectations. I'd rather, so 30 to 45, I would say. On that last slide, he mentioned different loan programs: home improvement, one-time close, purchase of a single-family residence, purchase of land, purchase of condos, purchase of manufactured homes. We have loans for all of that, but they're going to be different rates and they're going to be different terms and different qualifications. So, for example, on a manufactured home, the longest term we offer is a 15-year note, and it requires a 25% down payment. So, as Victor was pretty transparent about the investment property loans, I tell people that our manufactured home loans are just not very good, and I recommend that they call someone else. I mean, like I said, I'm a homeowner, and I don't feel comfortable putting people in a loan that I just don't really think is a good loan. So if you wanted a manufactured home, I would definitely tell you. I could give you a name of somebody with, I don't know, Quicken, or I don't know, somebody that has a little bit more options on those types of loans. But just to go back to my point, every kind of loan program is going to have a different rate, different terms, different guidelines. So let's see.
Question.
Yeah.
Can you expand more on the construction loans?
So the construction loan, and that's a great question. So they are, if you already own land or you don't already own the land, but you want to find some land eventually and you want to build. Basically, the construction loan is I'm drawing a blank here. It's just like a regular purchase, okay? Really the same documents, pretty much, with exception of you have to have a builder engaged already. You have to have plans, the drawings, the elevation, the specs for what materials you're going to be using. Are you going to put a marble staircase in, or, is it a log cabin? The contract with the builder. So there's really 4 things: the budget, the contract, the drawings, and the plans, drawings, elevations, and the specs as far as materials. Those things we have to have those at the beginning of the process, just like with your financials. We will do an appraisal based on those construction documents. So the appraiser will say, okay, you're building this house for $500,000, or you're building this business, this church for, whatever, $750, whatever. They're going to kind of give an estimated, okay, we agree that that it's going to be that value once it's done. Okay, so everything's done based on this projected house being finished, right? The loan itself will give you, at minimum, 12 months to build. During the first 12 months, it's interest-only payment, and it's like a line of credit, so you start at zero. And every month as the build goes on, obviously, your builder will be taking money from that line of credit. And so your payment's going to go up a little bit, but it'll stay interest only until the house is finished. When the house is finished, it automatically transitions into the permanent loan. So you are locking a rate at the very beginning. The rate stays the same through the construction phase, and then it just automatically goes into the permanent loan. So that's why we call it a one-time close, because you're signing everything before you even start construction. And then after, when construction is finished, before it turns into the permanent loan, you and the builder will basically say, yep, everything's finished, all invoices have been paid. You just sign a couple documents, and the loan transitions to the permanent loan. And you just start making your regular payments. Does that make sense?
Yes. Can you be your own builder?
Can what?
If you are a builder, can you be your own builder?
You do. You have to have a builder. Yeah. So.
And I think what Gideon is thinking about is, say I'm a contractor with the state of Texas. I have the budget, the drawings, the specs. But my plan is find a foundation guy, build a foundation, pay him off. Find a framer, build it, pay him off. Find a roofer, do the roofing, pay them off, and so on until the house is done.
Yeah, again, really, Prosperity doesn't want you to be your own builder. Because here's the thing, and one thing in Texas is we have really strict laws about giving money. We have these home equity laws for homesteads and things like that. So if you're your own contractor, your own builder, we're giving you money, that then becomes a home equity loan, which Texas is so serious about that they wrote it into their constitution. That we're the only state that has mortgage laws in the constitution like that. So basically, it then becomes a home equity loan, not a construction loan. A construction loan is a mechanic's lien. So there's some technicalities. Again, kind of like when I talked about the quadplex and the second home, there are some technicalities, but in general, I just have to say Prosperity won't, if it's your own DBA or, it gets real hairy. Yeah.
That would be considered a drastic exception if they did.
Yeah.
So you probably have to get an outside vendor to do that, draft up your scope of work with the specs and
Yep.
everything.
Yeah.
It doesn't have to be like a contractor, even if it's a small scale contractor.
Yeah, I mean,
I can answer this.
okay, go
So,
ahead.
because I work with construction teams right there with me.
Good.
So they don't have to be a major company or anything, but there is also a blacklist, if you will, of contractors who have not done right or that have violations for other reasons or whatever, integrity reasons, stealing money. if they appear on this particular list, then obviously they can, but there's no list that you got to be on to get approved for that. Based on what the construction guys are saying. So for you, I think the next step will be get your pricing for everything that you want to do at the back end. And like Mary said, that's how they're going to evaluate what that valuation is for them to determine how much to give you for the construction and the permanent financing on the back end. Yes, sir.
My last question. What if I own land in California and I want to build it?
The land has to be in Texas or Oklahoma, right? And California is not an adjoining state.
Yeah.
California won't work, not with Prosperity Bank.
Oh.
No. Would they even look at that from his collateral for anything that he owns?
You know, Prosperity will it's a good question. I don't have the answer to. I know that they will make exceptions if you already have a banking relationship with us. So if you knew you kind of wanted to go that route, I would definitely, I think there's some different criteria for the banking relationship, like how long and what's the balance, that sort of thing. Prosperity is kind of a regional bank. We do loans in all 50 states, but not construction loans in all 50 states. We do construction loans in the surrounding states that touch Texas, so New Mexico, Colorado, and Oklahoma, and that, but Louisiana. But as far as construction loans, we might be able to do it if you have a banking relationship. It has to go to higher management for approval of something like that, but yeah.
So I have a few giveaways. I should have handed these out earlier, but I'm gonna give you guys some notepads and some flyers with our information on it. Any other questions right now? We would love to. Oh yeah, sweet. How you want to give it away? You want to do a raffle? Yeah, let's do a quick raffle for the mug.
Oh, that's for the pastor.
Yeah, there you go. He just won. There you go, just like that.
For the pastor, yeah.
All right, sounds good. Sounds good. All right, so we greatly appreciate you guys having us out here. This has been great. I mean, you guys had great questions, so I know you're going to use this information, but information is useless unless it's applied, right? So you got to find a way to move forward with whatever you focused on. And if we can help, I would love for you guys to get Mary's information. Obviously, she's taking time on a Saturday afternoon to come out here and share with you guys. So if you do want to get moving on a mortgage, get with Mary or reach out to me and I'll get you connected to Mary. But I think this is it, Mr. Gideon. I really appreciate it. So I'll hand some of these out and let you take it over. Thank you.
What do you all say?